Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for August 3rd. It's August, if you can believe it, 2021. I'm Ken Adamo, Chief of Analytics at DAT, joined by Ned Damon, who's our Principal Data Scientist, and Dean Croak, who is our Principal Industry Analyst. Welcome, guys.
Good morning.
Howdy.
I can't help but hide my somberness as the passing of Dusty Hill from that little old band from Texas, ZZ Top, is weighing heavy on my heart. Some of the best live shows I've ever seen, and we'll bring it back around to Texas later in the show, but I tried to get ZZ Top as our intro music today, but I'm not quite sure that we could afford those royalties. So how's it going, guys?
Good. Great.
I mean, I could complain, but I don't think anybody would want to listen.
No, I'd rather hear some LaGrange. Anyhow, that's enough ZZ Top for today. So for those not familiar with our show, we're here every Tuesday at 10 a.m. Eastern talking about the freight markets, trends we're seeing, and most importantly, opening it up for your questions. So if you have any questions, please feel free to drop those in the chat or comment section below. We're going to have a lot of really interesting things to talk about today and a bit of a kind of unique look of things for the Ask IQ US question of the week. So again, don't be bashful. Go ahead and jump in the comment section there, and marketing will get those questions over to us. So with that, I'm going to hop into our key trends of the week. On the rate side, things rather stagnant. Volumes a bit lackluster. Dean's obviously going to cover this in a lot more detail. Port congestion seems to be one of the main themes that continues to persist, especially in Southern California. We're going to talk about that more again at the end of the show, but you'll see it reflective in a lot of the MCI and rating data. And then as of yesterday, the bridge in Memphis, I-40, open both directions after 83 days. I think there's a lot of people very happy about that. Probably a lot of my former coworkers at FedEx that are thrilled to not have to detour around that anymore. So with that, I'll turn it over to Dean to walk us through our market update. Dean?
Yeah, thanks, Ken. Having a look at the load board activity last week in dry van, load post volumes increased slightly last week. A little bit of a surprise given it was end of month, only moved up by 1%. As was the case last week, equipment posts were flat again, so the load to truck ratio only moved up by 1% from 5.93 to 5.93 from 5.97 loads per truck, relatively flat. In refrigerated, end of month shipping volumes did have the most impact in the reefer sector last week. Volumes increased by 4%. The load to truck ratio increased to 13.55, up from 12.83, had the biggest jump in the load board activity last week. In the flatbed sector, flatbed load post volumes reversed course last week. They decreased by 2%, now down 4% month over month. Capacity did tighten slightly. There were it was a decrease in truck posts. So what that did to the load truck ratio, it pushed it up to 47.4 from 44.57. Having a look at the market condition index, as Ken mentioned, the West Coast still continues to grab a lot of attention. There's a lot of what they call vessel bunching going on now outside the San Pedro port complex. About a third of all containers come into the US through that port complex. As of noon yesterday, there were 28 container ships at anchor. 9 of those are over 10,000 TEU containers, so there's a lot of volume still sitting there waiting to get unloaded. The ship with the longest delay so far at anchor is exactly 2 weeks. It arrived 2 weeks ago today, and it's still at anchor. Compared to this time last year, we have 28 vessels at anchor today versus 1 this time a year ago. So the number of ships coming in is increasing significantly. Lots of delays. Some inland intermodal congestion is also driving some spot market volume as shippers struggle to find intermodal capacity. We're seeing some transloading activity into 53-foot vans, fast becoming an alternate strategy to the railroad congestion. What we're seeing on the spot market side, on what I call the benchmark e-commerce import lane, Los Angeles to Phoenix, spot rates increased another 10 cents a mile last week to an average of $4.41, excluding fuel. On the other big warehouse market lane, Los Angeles to Stockton, it's at $4.12 per mile. That's a 12-month high. It's only $1.66 a mile on the return leg, so that makes a round trip of $2.89 for carriers loading both ways. In LAX overall, though, as a result of all the port volumes, mainly volumes are up 6% last week and rates are up 2 cents a mile. Having a look at the refrigerated market condition index, staying on the West Coast, capacity is generally tight, so that's making capacity tighter, overall for all equipment types. But in refrigerated, Los Angeles to Portland spot rates increased 12 cents a mile to an average of $4.36. 436 excluding fuel, another 12-month high. Round trip carriers are averaging about 288, which is about 12 cents a mile higher than the national average. Another lane that just continues to amaze me is the 270-mile run from Los Angeles to Las Vegas. Reefer spot rates cooled off a little bit last week to $5.32 per mile. That's a decrease of 46 cents a mile from the record high of $5.79 set in July. A little bit further over to the east in Philadelphia, rates to Miami surged last week, 17 cents a mile increase, averaging 260 a mile. And that's really to balance plunging spot rates in the opposite direction, where loads back from Miami to Philly are down around $1.50. And of course, that's largely because the produce season in May has subsided in terms of volume, and spot market rates are dropping dramatically. On the East Coast, Elizabeth, New Jersey to Atlanta, rates increased 16 cents a mile, averaging $2.57 for the 873-mile run. Having a look at flatbed in the market condition index there, wrapping up quickly for our update this week. Dallas to Atlanta inched up 3 cents a mile to an average of $2.33. Again, that's a 12-month high on this lane. We'll talk a little bit about Houston later in the show. Houston to Memphis, rates continue to climb, increased 12 cents a mile last week to $2.49. That's up 80 cents a mile over this time last year. So having a look at our year-over-year review of spot rates, despite last week being end of month, where we'd normally expect to see a surge in shipping volumes, dry van was relatively quiet. Spot rates only moved up by 1 cent per mile to an average of $2.42, excluding fuel. Dry van rates are still 52 cents a mile higher than this time last year, and 54 cents a mile higher than the last tight capacity period in 2018. In refrigerated, after decreasing for the 3 weeks prior, reefer spot rates increased the most last week of the three equipment types, up 3 cents a mile to an average of $2.76, excluding fuel, still 65 cents a mile higher than this time last year. And lastly, in flatbed, rates decreased for the 4th week in a row, not a significant decrease. They shifted down by 1 cent per mile to an average of $2.67, excluding fuel, still 66 cents a mile higher than the same week last year, and about 22 cents a mile higher than the last period in 2018 when we had a flatbed rate rally about this time in 3 years ago. So that's it for the market update. Over to you, Ned, for the short-term forecast, long-term.
Long-term forecasts, yes. No, we've got a special treat for everybody this week. We're going to be doing the long-term forecasts. So the first rule of a graph is you have to explain the graph before you can start talking about what it means. And this graph has a lot of information on it. In the blue, you can see the market rate. In this case, it's the dry van rate observed by DAT, and this is going back through 2015. So there's actually about 1.5 to 2 freight cycles in this guy, depending on how you measure a freight cycle, and we'll trilling too hard. Well, moving forward. And that blue line is reflected on the left axis. On the right axis, you'll notice it's percentage, and that's indicated by the gray shaded region. And that is the year-over-year comparison. So, for instance, if you look at the gray region in 2018, you'll see that it is at about 35-ish%. And that means that the rates on that day were about 35% higher than the year-over-year comparison, so the prior year. So one of the things you'll notice as you move off to the right is that at the far right, we have 3 dotted lines, one blue, one red, and one green. These reflect 3 different versions of the ratecast model, a sort of flagship standard model that's in blue, a more bearish model that's in red, and a more bullish model that is in green. So all of these are looking into the future, and once we're into the area where we have the dotted lines, the gray year-over-year comps are reflecting the blue line for the forecast, and looking at what the forecast is relative to the prior year. So with all those preliminaries out of the way, we can now talk about what the model is forecasting, and also talk a little bit about this gray region. So one of the things that you'll notice first is that, unsurprisingly, 2020 and 2021 have been kind of goofy years, but as soon as you start moving into the May-ish space, oh dear, no, we're good. As soon as we start moving more into the May ish space, the comparisons start to get a little bit better. The year-over-year comps tend to level themselves out and go from being completely ridiculous to just being aggressive. So for the 3 model runs, you can see that I'm going to talk mostly about the blue line. It's really expecting that the overall trend, which is somewhat positive, is going to be continuing heading into the end of the year. And then after that, there's going to be a drop. The more bearish, the red line, is expecting things to continue kind of flat, middling around where they are, with a little bit of overall negative pressure, and then a pretty sharp drop when we head into the post-holiday season. And the aggressive model, which I wouldn't put a whole lot of stock in right now, but things do happen, is expecting a pretty sharp rate uptick and then a leveling out as we're heading into the holiday season. And that is it for Van. Next, we're going to move on to Reefer. I'm going to spare everybody a complete relitigation of the exact details of the chart, but just once again, the blue line is the market rates observed by DAT going back through 2015. The gray shaded regions are the year-over-year comparison. And then off to the right, are our forecast models in blue, green, and red. Blue being the case that is shown in the shaded region below. And here for Reefer, you can see that there's a little bit less optimism, even in the optimistic model, although it does look upwards a little bit. But it's not quite the same very sharp upward tilt that you saw in the dry van case. In the neutral and the downward case, we're expecting rates to stay more or less where they are, with a really sharp uptick as we head into the pre-Thanksgiving season, fall season, late fall season, and then a drop after Christmas from those. Finally, moving into the flatbed space, here we have a lot of model divergence. Once more, blue is the market rates observed by DAT, gray is the year-over-year comparison. Both of these are going back through 2015, and then the long-term rate cast models are off to the right, green being the bullish case, blue being the neutral case, and red being the bearish case. Here you can see that the bullish case is expecting that rates will more or less hold their value and then tick up as we head into the early part of next year. The neutral case is expecting a slide to continue heading in through the later part of the year, and then an uptick after the holidays. And the bearish case is expecting a pretty pronounced slide moving in through the fall, and then flattening out as we head into the holiday and post-holiday season. And that is it for the forecasts. And we're going to move on to our IQ question of the week, which I actually have prepared for a change, and that is, why is lane balance important to the spot market? There we go.
Cool, thanks, Ned. So, kind of level set. I'll tee this up, and then we'll kind of get into the discussion. So when we say lane balance, we mean, if you think about a market, let's just pick Atlanta, how many of that equipment type are going in versus going out? So all of the cumulative freight inbound for a given time period and equipment type versus all of the freight coming out. So that's really important, obviously, right? If you're an asset-based carrier with a network, and I guess even if you don't have a network, but even more importantly if you do. So if I have 20 trucks going in or 20 trailers going into a market and only 10 coming out, I have to do something with those 10. I can either deadhead to a market that has freight. I can put those trailers on a rail car and reposition them. I can deadhead all the way back to where I came from, and then that's what Dean refers to and we refer to as a round trip rate. So it's very important to understand that it's a huge kind of body of study in network design and optimization for asset-based fleets. But we talk a lot here about the spot market. And if you're a broker and you book a truck inbound to Atlanta, you don't necessarily have to worry about what's going to happen next, right? You are just worried about that shipment on that carrier. Odds are the next shipment you haul is going to be with a different carrier or a different truck, and kind of that isn't necessarily a physical balance problem. What we're going to talk about here, though, with this chart, is why you should maybe consider balance in the spot market, because whether you're specifically responsible for repositioning that equipment or the surplus or shortage of equipment in an area, the spot market will, since it's an efficient market, correct itself. So if there's more trucks coming in than going out, or vice versa, there will be pricing consequences. So let's take a look at this chart. Apologize, it's a bit of an eye chart, but so this is obviously the United States, and we have all of our 135 continental United States KMAs, our key market areas, as the geo points. Each bubble is sized by the number of shipments touching that KMA over the last 7 days in our database. So the bigger the bubble, the more freight. And it makes sense, right? You have to really squint to see the dots in Montana and the Dakotas. The ones in central Illinois and Atlanta and central Georgia and Southern California are larger. The gray are the total number of inbound shipments, and the blue are the total number of outbound shipments. So when there's more blue than gray, there's more freight going out than coming in. And when there's more gray than blue, there's more freight coming in than going out. So let's pick a few key markets here. So Southern California, notoriously imbalanced. So there's a lot more freight coming out of Southern California than there is going in the spot market. So how could we know that without seeing the freight flows? Well, freight going into Southern California is largely considered a backhaul lane. Freight coming out is considered a head haul lane. Southern Florida, much different place. Much more inbound balance. So there's a lot more freight coming in than there is going out. That's why it's basically free running out of Southern Florida. Get that right. I don't want to insult either of those two populations of people. Obviously a lot more freight going in than coming out. So you're going to pay a lot more than coming out. So I'm going to turn it over to Dean to think about this from a carrier perspective. And if you're an independent owner operator or a small fleet owner on the spot market, why is this important to you?
Mostly because there's a lot of change in the post-ELD era that's driven a lot of the importance around this, because time is money these days. Every time you're over 5 miles an hour with your truck, you're recording on duty status. You've only got a finite number of hours each week to run. You've got 60 hours in 7 days. Every hour you run empty comes off your weekly, productive total. So, carriers look for a couple of metrics. One is and there's two types, right? So there's the one-way network where carriers run from A to B to C to D to E. And then there's the majority of carriers that, run A, B, C back to A, or A, B back to A. They want to be home at a certain time each weekend to take their 34-hour restart. So it becomes really important when you start to think about what are your KPIs, which are loaded miles per tractor week and or revenue per truck week. So they're very important things. And with the fixed and variable costs that stay pretty much the same. I mean, your variable costs do drop when you have less weight. When you're deadheading, your MPG does improve slightly. But running empty means that you're still burning fuel and there's still wear and tear on your truck. So what a carrier looks for is pretty much maximum loaded miles, minimum deadhead miles between points. So as opposed to the broker network that may be looking at one load at a time transactionally, the carrier is really thinking about, how do I get home? How do I maximize my loaded miles per week? And how do I minimize my deadhead miles? And that's why lane balance is absolutely critical. And the example we just gave a little while ago of Los Angeles to Portland is a really good one. You've got $4.36 a mile north and you've got $1.50 a mile south. But for a carrier that's doing that understands the market, it's still a round trip mile of $2.88, 12 cents above the national average. So that sort of is a good example, I think, of why you can balance each lane, knowing that the rates are higher because the volumes are higher further north than they are coming back south. But you're still making a really good rate per mile by the time you get back at the end of the week.
Yeah, and I think that it's also important to note that because of recent trends, that there's a lot more imbalance than people would necessarily expect. Like if you look at the Central Florida bubbles and you compare them to, say, like the Stockton bubbles, or even the Phoenix bubbles, they're not that different. And so having a lot of people know just sort of intuitively that if you're going into Florida, you need to charge a premium because you're not going to be able to get out. But I think for a lot of newer carriers or brokers who aren't necessarily as aware of what the carriers are experiencing, they don't know that you're swimming against the stream one way or the other, or they don't know that they're going to need to. And so having that information and knowing when you need to be charging a premium to make sure that you're not running deadhead is really important.
Well, I think, there's the try. I mean, the Florida examples are softballs, right? That's happened.
Right.
That's been that way forever. It's a great point, Ned.
Yeah.
I think what we've seen during COVID, though, is, I mean, there's been these periods where things have gotten way out of whack. And honestly, like, we look at this stuff every day. Like, that's what we're paid to do. And Stockton caught me by a huge surprise just updating this chart, right? Apologies for looking off to the side, but that's where the numbers are, and I can't see very well. Stockton in the last 7 days for dry van had 5,800 shipments coming in, roughly, and only 4,200 coming out. And that's a 36% imbalance. And that's not, I mean, typically it's a fairly imbalanced market, but not to the tune of almost 40%. And those trucks that land there have to go somewhere.
Yep.
Right? So, and they're not going to go up to Seattle or Portland, most likely. Where are they going to go, Dean?
Probably going to run straight back down the I-5 is what I'd be doing. If I could run 412 a mile northbound, which is what they're getting right now, you could either wait for a load, which is probably less likely, or just come straight back home for, what is it showing right now this morning, $1.66 a mile. So your round trip miles are still pretty solid.
They are. And I think that's something to really kind of consider. And again, as a smaller broker, I think this is important to understand pricing dynamics. As a large broker where you're moving a lot of traffic on a lane, right? So let's not kid ourselves. The spot market is much smaller than the contract market. But I think that's why it's much more important to keep tabs on these indicators, because small shifts in the contract market can have huge implications, right, in the spot market. So I'm all of a sudden now, if I'm getting a bunch of freight, so typically for Southern California, I'm looking at a lot of the freight coming directly in, right? The loads that are going to land there that are then going to turn and be available capacity for outbound. Well, now I need to consider all of these shipments that are now going to, all these trucks that are going to be coming in off of shipments that are going to be deadheading into Southern California. How's that going to play on the rate pressure? And those are LA, Ontario, even San Diego, I guess, a little bit. Those are markets that notoriously oscillate. I mean, we're talking big swings, right? In like 25, 35 cents can move in a few weeks.
Yep. And I think, some of these lanes have decoupled because of that massive volume that's been coming into the West Coast, right? Because that freight's got to go somewhere into those markets like Phoenix and Stockton and Denver to a degrgree. That's why we've seen such high rates on the northbound lane. I think the ELD point can't be overestimated enough, because on those lanes where you can run round trips in a day, that's what carriers are doing. You'll just you won't wait a minute, especially if you've got a good drop and hook set up on the northern end in Stockton. You'll just simply drop and hook and head back south and do a round trip each day. That's how you can start to get good utilization on the broker side, because the time becomes the biggest imperative in this the current ELD era that we're in.
Yeah, for sure. I mean, look at so Stockton's kind of if you're a college basketball fan, like a mid-major. It's not a blue blood. It's not a Duke or a North Carolina, right? So, but let's focus in on a blue blood for a minute. Houston, really odd. It's been trending in a really odd direction, right? Normally a very balanced market, right? It's kind of competing in that, Dallas is its sort of ancillary. There's a ton of freight. There's energy implications coming in and out of there. There's a lot of, right, even produce implications. It's a big port. Mainly an energy port, right? But still other traffic coming in there.
Yep.
So it's currently sitting almost 15% imbalanced, which is not crazy, right? But still, not typical for that market. So there's definitely going to be pricing considerations as a result of that.
Right. In particular on the flatbed side, right, Ken, when you think about all the drill pipe and casing that have to go out to all the major oil fields to the west and north of Houston.
Yeah, the top three most imbalanced markets, and I love that you pulled this up, Dean. And I'm sorry I'm speaking in numbers that you guys can't see, but it would be pointless to put a spreadsheet on the show.
That's not good TV. Yeah.
Texas, had Houston, Dallas, and Fort Worth, all three at the top at 13, 23, and 28% imbalanced, respectively, for flatbeds, right? So these are things, and why do we bring this up? And again, if you guys hate this type of discussion, leave a comment. If you want to see more of it, leave a comment, because what we're trying to do is at least once in a while kind of break down analytic strategy on the show, as opposed to kind of just talking about topics of the day, because we're hearing more and more from our listeners that they want a kind of insight into how we think about the freight analytics that we do. And if you're a carrier sitting there going, why do I care what the broker thinks about? I think there's a lot of really compelling reasons to understand how the brokers are thinking when they're making pricing and load booking decisions, and vice versa as well. If you're a broker, I think the single best thing, especially if you're on the capacity side, is to think like a carrier, because that's going to help you better understand, and maybe not understand, but anticipate market changes based on ancillary data you're seeing, right? We talked to a very large broker last week, and they said, I pretty much have the first, I forget what it was, but like the first 10 shipments on a given lane on a given day, I know pretty well what's going to happen. I'm just trying to predict when that's going to flip, right? Because shipment 1 through 10 are pretty predictable. 11, 12, I start to get nervous. Somewhere in that 13, 14, 15 range, I start losing money. And then 15, 16, 17, I could be losing $1,000, $2,000, $3,000 a shipment. And it could blow my entire day on that lane. So those are the kind of things I think that it can help you anticipate market changes by looking at, just a simple graph. I find it helpful. So
the other thing, Ken, is the impact of day a week, right? That has a huge impact on all of this, because I find a lot of guys are being very selective about loads as the week goes on, as they try to shoehorn in a trip into the available hours they've got left to get home to have their 34-hour restart. There's so many more. It's such a complex equation for a carrier. It's not just a one load transaction.
For sure.
Yep.
So do we want to get to some of the questions of the week, Ned, or some of the questions?
Yeah,
from our,
I'm not sure we're going to be able to get through all of them, but let's do as many as we can. Gary Bates, what markets are the strongest in the winter for flatbed?
The least snowy.
Houston's always a number one market year round. I don't know that we've done it by season, though. That would be interesting.
Yeah, that'd be interesting. I think some of the lower energy driven markets, like some of the the markets that are a bit insulated, because that wasn't a joke. The markets that get really cold and bad weather in the winter become pretty treacherous from a flatbed perspective. So,
Edward Maggiano, are we seeing the Florida seasonal rates reefer and van drop follow previous year's declines? If so, at what percentage? And if not, how does it compare to the previous 5 years?
I'm not sure if he means inbound or outbound.
Yeah.
They are pulling back, right? The produce rates are following a very seasonal trend, correct, Dean?
Correct. Was the question about Florida, Ned?
It was FL, which I'm interpreting as Florida.
Yeah,
Florida
they're definitely, they're definitely. Inbound rates are going up significantly since mid-May, and northbound rates are going down significantly. So I think the answer to the question is generally yes, but I'm not sure on what lane that we're talking about. But northbound rates out of Lakeland and Miami are certainly plummeting at the moment.
Florida's going to Florida.
Yep.
Ashley Botex, how do you think the supply chain disruptions due to recent devastating floods in China and Europe will affect spot rates in the next few months?
Europe, not so much. We don't have a ton of, at least not that we're concerned with, freight that's why the Ever Given thing didn't necessarily impact us all that. It was a couple of vessels, right? Destined for Savannah. I think China could be, depending on a lot of that Black Friday freight. The back to school freight's already done. Not done, but it's the Chinese part of it, the Southeast Asia part of it. I think a lot of like the electronics and whatever the toy of the year is going to be and all that stuff could be impacted to the extent that disrupts flow from inland to the port, right? So inland China to the ports. And that's been a story, right? That hasn't just been due to the recent weather. They've been struggling. I don't know if you've seen the videos of the lines getting into ports and kind of some of the disruptions. And I think they had landslides earlier in the spring on some of their major routes to the ports. So I would keep an eye if your business is exposed to retail imports this fall, because as Dean mentioned, let's put the tea leaves together. You got vessels already stacking up in Southern California. You already have trouble at the ports in Southeast Asia. This could only add to that. It's certainly not going to assuage any of that.
I think, Ken, for Ashley's to answer, put a finer point on Ashley's question, we see a very strong correlation between the number of ships at anchor, containers coming in each day, and load board spot market load posts. So I think that as you've got a lot of devastation in the floods in terms of impacting the rail lines, where a lot of those have been washed away in China and in Europe, you're going to see a ripple effect, and it'll be more so in the surging, what they call spiky volumes of ships coming in. They'll be all out of sequence, off their regular schedules. So you'll see what we've got on the West Coast now, which is vessel bunching, where you start to see surge volumes and then they go away. There's another 28 vessels due in the next 3 days in Long Beach. That's on top of the ones that are already sitting there at anchor, some for 2 weeks. So that causes this highs and lows, and that's what we'll see more than anything, where you'll see spot rate movement on a daily basis as the volumes surge.
Shanika S asks, sorry, do we have time for more?
Yeah, go for it.
Shanika S asks, do you think there will be another shutdown because of the Delta variant? I really hope not.
No, I don't think so.
Yeah.
I don't think so. I really don't. I don't think there's popular support for that. And I think you're starting to see, at least in our area of the country, big retail chains are strongly encouraging masks. I mean, they're requiring them of their workers because they can, but I don't think you're going to see. I don't think you're going to see a repeat of what happened in 2020.
No, I don't think there will be shutdowns. I do think that there will be impacts, to the extent that continued COVID pressure is going to keep industrial lines slowed because of social distancing, et cetera. Then I think that there's going to be impacts, but I don't think it's going to be as severe.
Yeah. Certainly on the driver's side, there won't be much impact. I saw a sticker on a truck at a truck show and it said social distancing for a living.
That's a good one. I think we just need to get to our numbers from a vaccine perspective and get on with it.
Yep.
Got one more question from Paula Harrell. Brunson, out of Network 3D and Logistics Operations at Kellogg's, retired. What about the storm? Could that impact the Houston market?
Absolutely. I mean, it does every single time, both before in terms of staging emergency supplies and after in terms of the rebuilding effort. That happens all the way along the Gulf Coast. So, that
is there
absolutely.
A storm brewing?
I haven't seen one. I'd have to check.
I haven't seen alerts for one, but
the storm. Maybe Paula knows something we don't this morning.
Yeah. I was going to say, if there is something looming, there could be. That could be why we're seeing some of that imbalance, right? But I haven't heard anything. At least nothing tropical. Maybe there was tornadoes or something that blew through.
Right.
I don't know.
And that is it for the questions we've got coming in.
Right.
Ken, you ready to do some plugs?
Yeah, I am. I don't know if we have a slide for this, but I know last week I brought my Steeler hat in, but I obviously wasn't able to join the show due to technical difficulties. But DATCon 2021, back and better than ever. I gotta look at the dates. October 4th through 6th in Austin, Texas. I told you I'd be bringing the Texas reference back around. We're going to have it's the first time we've ever had shippers, brokers, and carriers at DATCon all together. Tons of really great sessions. I'm trying to cobble together an analytics track. So anyone watching the show that has an interest in the analytics that we do, we're probably going to have 10 to 15 spots available for that. It's going to be a very limited. I want to make sure that I can walk to my car safely and not worry about marketing hiding under my truck waiting for me. So I'm trying to kind of cobble together 4 or 5 sessions, but kind of a dinner with the data science team and things like that. So if you're interested, drop us a line in that. Terry Bradshaw will be there live in person doing our, I don't know if you want to call it a keynote, but his kind of take and perspective on exceeding. I've been educating my team at DAT on the Immaculate Reception. Having been born and raised in Pittsburgh, it's kind of, you watch that before just about anything else. When other people were watching Disney, I was watching the Immaculate Reception on loop. But it's really great. I've spoken as a customer at several DATCons. I really, really recommend it. I don't think it's that expensive. And if you're kind of cool with traveling, I think it's also happening during Austin City Limits weekend 1 or 2. I don't remember exactly what weekend. So the whole town's sort of hopping. And it's generally a pretty fun event. We throw a big party the first or second night. So any questions on that, you can go to the website linked in the graphic that's being displayed right now. And like I said, if you have any interest in the analytics track that we're putting together, feel free to let me or someone on the team know. We can talk more about that. Capitalist in the Freightvine podcast, I think he just had Bill Cassidy on. Is that right? I think that was his most recent one. Yep. Bill's always a great conversation. Really like talking with him. He's over at the Journal of Commerce. What else am I missing, guys? Any more plugs?
Yep, I'll be on the Landline Now show tomorrow night at 7 p.m. As I am every week, 7 p.m. Wednesdays.
Great. Ned, anything cooking in your world?
Not that people need to know about.
All right. Well, with that, we're going to sign off. We will be same old kind of thing next week. We will hopefully all be live together in Denver with Dr. Chris Kaplis in 2 weeks. So that should be a really exciting show. But like we mentioned, a lot of fun stuff happening, a lot of exciting stuff. And we hope you guys have a great week. Bye.
Bye, Zeus.